Okay, let's go ahead and talk about a partially owned subsidiary with the differential for the year following acquisitions. In other words, we're going to go ahead and include income, dividends, things of that nature. Unfortunately, the tables in this PowerPoint are going to get harder and harder to keep a decent sized font, but we'll do the best we can. Okay, let's go ahead and continue with the example from the previous slideshow, the one titled Partially Owned Subsidiary with Differential. Again, to refresh our memories, we had the following. January 1st, 01, big company buys 60% of little company for $450,000. The fair value of the non-controlling interest on that date is $300,000. Little's book value is $500,000. Little has inventory which is undervalued by $50,000, FIFO basis, and property, plant, and equipment, 10-year life, which is undervalued by $100,000. We do our cost versus book value analysis, again the same thing we did the previous slideshow, and we find that we have that's how it plays out with goodwill of $100,000 for the company as a whole, $60,000 of goodwill for our portion. Now let's go ahead and assume that by the end of the first year, Little reports income of $80,000 and pays dividends of $20,000. Okay, let's go ahead and do our equity method entries first, just for old time's sake. First, we have to record the acquisition. So we debit investment in Little and credit cash for the purchase price. Next, we record our share of their income. Again, they reported $80,000 in income. We own 60% of their stock, so we get 60% of the $80,000 or $48,000. Dividends, they paid $20,000 in dividends. We own 60% of their stock, so we get 60% of the $20,000. And then amortization. Again, it's always going to be income, dividends, amortization. For the amortization, we've got two things going on. First, we have the amortization related to the inventory. Again, inventory was undervalued by $50,000. Our share of that was $30,000, and that's being written off entirely in the first year because we assumed a FIFO inventory basis. So we're going to reduce our investment account by $30,000 and reduce our investment income by $30,000. Next, we have the amortization for the property, plant, and equipment differential. Again, it was a $100,000 differential with a 10-year life, so that's $10,000 per year, and again, we own 60% of that, so our share of the $10,000 is $6,000. Okay, now let's go ahead and do our elimination entries. Recall from the previous slideshow that Little had owner's equity at the date of acquisition of common stock of $200,000 and retained earnings of $300,000. That's where the $500,000 book value came from. So first, our S entry. Again, we eliminate the beginning of year equity accounts. We establish those differential asset values, the inventory, the property, plant, and equipment, and the goodwill, and we close those against our beginning investment balance, and the beginning of year non-controlling interest is established. Then we have A for amortization. And again, the two things that are going on. In the S entry, we create $50,000 of inventory, and then we realize that by the end of the year that should all be sold, so we remove the inventory with a credit and debit cost of goods sold. Likewise with the property, plant, and equipment, it's $100,000 of additional property, plant, and equipment value being amortized over 10 years, or $10,000 per year. So we're going to go ahead and record an additional $10,000 of depreciation expense to get the depreciation expense up to what we feel is the correct value. I for income. Again, if you look at the equity method entries on the previous slide, we had $48,000 in income, less $30,000 of amortization, less $6,000 of amortization. So the investment income was $12,000, and that needs to be eliminated. D for dividends. Again, the subsidiary had $20,000 of dividends declared, so we eliminate that on the credit side, and we split that 60-40 between our investment account and the non-controlling interest. Finally, the Inc., the income to the non-controlling shareholders. Now remember, we're going to give the non-controlling shareholders their share, 40%, of the subsidiary's adjusted/realized income. We start with Little's reported income of $80,000 and then add or subtract to reflect the effects of the elimination entries. Now looking at the elimination entries, under the A entry for amortization, we have a $50,000 debit to cost of goods sold, so that's going to reduce income, and we have a $10,000 debit to depreciation expense, so that too is going to reduce income. So our adjusted income is the $80,000 that's reported, minus $50,000 minus $10,000, or 80 minus 50 minus 10 is $20,000. So their adjusted income is $20,000. The non-controlling shareholders get 40% of that, or $8,000. And so the income to the non-controlling interest, $8,000, and the credit to the non-controlling interest, $8,000. Okay, now let's go ahead and post all this stuff to the worksheet. In this worksheet, again, a lot of these numbers are sort of random. I had to pick certain numbers to meet certain criteria though. Again, the investment in little account has to have the correct balance based upon the equity method entries. Likewise, the investment income. The subsidiaries' equity accounts have the specified values. But a lot of this stuff, a lot of the assets and liabilities and so on are just sort of random numbers picked at random. So let's go ahead and post these elimination entries. First, let's post the S entry. Again, we take the debits and credits from the S entry and put it in the debit and credit columns of the worksheet. Then we take the A for amortization entries and post them to the worksheet. Again, basically, in the S entry, we created 50,000 of inventory. Now we're taking away 50,000 of inventory and debiting cost of goods sold. And we're going to record $10,000 of additional depreciation expense. And then finally, we post the I, the D, and the Inc entries. Again, putting the debits in the debit column and the credits in the credit column. And as always, I need to caution you on the differences between investment income versus investment in little, and the difference between income to the non-controlling interest and non-controlling interest. Again, you need to keep track of which one you're dealing with for each entry. Now let's go ahead and start filling in the worksheet. Again, we add across each row as appropriate. So sales we add across, there are no adjustments. Cost of goods sold we add across, as reported is $500,000. We tacked on another $50,000, so that's up to $550,000. Likewise for depreciation expense, as reported, big has 200, little has 100,000. So as reported is 300,000. We added 10,000 more to get up to 310,000. Other expenses, there are no adjustments, so we simply add across. 150 plus 120 is 270. The investment income goes away, of course. And again, when we get to consolidated income, we don't add across, we work our way down the income statement. So 1.2 million in revenues, minus 550,000 of cost of goods sold, minus depreciation expense, minus other expenses, gives us consolidated income of 70,000. We take away the $8,000 of income to the non-controlling interest, and that leaves us with $62,000 of income to the controlling interest, which we then transfer down to our statement of retained earnings. Now we can go ahead and do our statement of retained earnings. Again, we add across the beginning retained earnings, and again, we've eliminated the subsidiaries' beginning retained earnings. We're left with the parents. We have our income that we brought down from up above. Dividends, again, we eliminate the subsidiaries' dividends, leaving us with the parents, and that gives us our ending retained earnings, which again, we immediately transfer down to our balance sheet for ending retained earnings. Now we can go ahead and combine our balance sheets. Again, we simply add across, keeping in mind the debit and credit rules. Cash and receivables, there are no adjustments, so we simply add across. Inventory, now as reported, is $350,000 for the parent, $300,000 for the subsidiary, a total of $650,000. We add $50,000 and then take away $50,000, so we're left with the original $650,000. The investment in little account goes away as always, and again, that's our check figure. Go ahead and add across that row and make sure it nets out to 0. If it doesn't, you've got to go back and find out why. Property, plant, and equipment net, as reported, we've got $950,000. We added $100,000 from entry S, and then we took away $10,000 as we started writing it off. So the final property, plant, and equipment net figure is $1,040,000. And then lastly, we've got our goodwill of $100,000 that we established in the S entry. On the credit side, we have no adjustments to our liabilities, so we simply add them across. The common stock account, as always, we eliminate the subsidiaries' common stock, we're left with the parents. We have the retained earnings in place that we brought down from up above. And the non-controlling interest, again, we start with $300,000 looking at the debit and credit columns. In the credit column, we put $300,000 there, that was the beginning of your balance. We added $8,000, which was their allocation of the subsidiary's income. Then we took away $8,000, which was their allocation of, or their receipt of the subsidiary's dividends. And so we're left with an ending balance of $300,000. Just an unfortunate coincidence of numbers that it came out to $300,000. Okay, let's go ahead and just because we can, let's go ahead and see what the first elimination entry, the S entry, would look like in the following year. Now, to refresh our memories, let's look at the elimination entries from last year. Those are on the left-hand side in the smaller font. Again, we have the S, A, I, D, and Inc entries. And again, what we need to think of is how these entries carry forward to the following year. Again, the S entry for 2002 on the right-hand side, we're going to eliminate the subsidiaries beginning of your equity accounts. The common stock is still 200,000, but if you look at the previous slide, the subsidiaries ending retained earnings in 2001 is up to 360,000. So we eliminate the beginning of year subsidiary equity accounts. Next, we need to go ahead and record the remaining differential asset. The inventory, and just going one by one. Inventory, last year we debited inventory for 50,000 in the S entry, and then we eliminated it with a 50,000 credit in the A entry, so we're carrying forward zero inventory. I put the inventory 0 on the right hand side just to point out that that is now gone and we never have to worry about it again. Likewise with the property, plant, and equipment net. Last year we debited property, plant, and equipment net for 100,000, and then we credited it for 10,000, giving us 90,000 net being carried forward to the following year. The goodwill we debited for 100,000 in the S entry, and we didn't touch it, so that's still 100,000 being carried forward. Now we get to the non-controlling interest. We can do one of two things. We could look at last year's elimination entries and say, okay, where did the non-controlling interest end up last year? Again, first we credited it for 300,000, then we debited it for 8,000, then we credited it for another 8,000 for a $300,000 net credit, and that's what we're reestablishing in the S entry for 2002. Alternatively, if you look at the sum of the debits, the common stock, retained earnings, property, plant, equipment, net, and goodwill in the 2002 S entry, they again add up to $750,000. Again, of that $750,000, 60% or $450,000 is ours as our investment in Little. The other 40% or $300,000 is the non-controlling interest. Now, you may note that the credits to investment and non-controlling interest are the same in both the 2001 and the 2002 S entries. That is just an unfortunate coincidence arising from the way I picked the numbers for this example. Normally they would not be the same. In this case they were, just by unfortunate coincidence for the way I picked the numbers.